Hello everyone and welcome to Accounting Academy channel. We're going to talk about financial accounting, and the first topic we're going to talk about is Introduction to Accounting. You're going to find this PowerPoint in a website in the link below. You can go there and download the PowerPoint if you want to. You're also going to have some practices there if you want to practice more and work on your accounting skills more. So let's start. So when we talk about accounting, what do we think of? Usually accounting is, we use accounting every day. I mean, daily basis we use it, and almost everyone uses the accounting concepts. Like when you get paid and you get your paycheck every week, weekly or bi-weekly, you as a person have to decide, okay, I'm getting an X amount of dollars, and you have to pay your utility bills, your rent, your probably car payment, and you also have to pay for your food, and you also have to pay for, you don't have to, but you want to pay for your some of the entertainment. Like for example, you want to pay for a gym subscription membership, or a Netflix subscription, or so you have to sit and decide, okay, if I use what is my priority to pay, and if I pay this much money on, for example, if I pay uh, Netflix, am I still gonna have enough money to pay the rent, or am I still gonna have enough money to pay for utility? So that's why we all use accounting concepts, like on a daily basis. But the definition of accounting in an accounting degree is an information system that is used to generate financial reports for individuals or businesses and their condition during economic activities. So same thing, is you generate reports for businesses or individuals during economic activities. So during that specific year or accounting cycle, or you generate that profits to them. Accounting, there are two major types of accounting. It's financial accounting and managerial accounting. So bookkeeping, tax, auditing, um, cost, all of those, fail, they fail, they go into one of these two. So financial accounting, what is a financial accounting? Financial accounting is an accounting that is prepared for external users. So when you think about financial accounting, you think that you preparing the statements not for managers or to make decision on it, but for external users. It can be investors, government, creditors, customers, anybody outside that entity. They can go and look at that financial report. Managerial accounting, on the other hand, is only for internals. So it's only for decision makers and managers to make decision upon that report. So it's internal users, like we said, financial accounting for external and managerial accounting for internal users. It can, for example, it can be cost, it can be profit, payroll, deciding how much you pay a person, or if you pay this person an X amount of salary, how much profit you will have, and all of that. And budget. And budget is how much money you have in the in the company that you want to spend, how much the budget that you want to spend on the particular month. So talking about business and accounting deals with businesses, we need to understand the types of businesses. So there are three types of businesses. There's service businesses, merchandising businesses, and manufacturing businesses. So service businesses, they provide service to you. In a return, they give the revenue. So for example, the service business can be, for example, Uber, they provide service for you. They transfer you from point A to point B, and as a return, they get their service. You pay for their service fee. Instacart, they provide services for you. You go, you add your items, and then they shop for you, and they deliver the items to you, and as a return, they get that service. You pay the service fee. Merchandising businesses. They buy the products from another vendor, or they buy the products from manufacturer, and then they resell it. So merchandising companies can be Amazon, Aldi. A gas station can be a merchandising business. Retail store, in a retail store, can be a merchandising business. Manufacturing businesses, they take the inputs and they convert it into a product, and they sell it. So manufacturing businesses, for example, HP can be a manufacturing business. Toyota can be a manufacturing business. Samsung, Apple. So all those they can be a manufacturing business because they take inputs and they convert them to a final product that they can sell. Now that we know the types of businesses, we need to know the forms of businesses, entities. So there are 4 forms of business entities. There is proprietorship, which is owned by one person, a business owned by one person. Partnership. Partnership is a business owned by 2 or more people. Limited liability company and corporation are slightly the same. Both of them protect your personal assets from your business assets. So if someone have to sue a LLC or a incorporation, they can't go after their personal asset. They can only go after their business assets. So that's are their similarities. Their difference is limited liability company is a business structure in the US, and is also you can register your business with your state. Corporation, you register your business with IRS. Another difference is limited liability company has the people in the LLC, they are called members, and LLC can have unlimited members, while corporation, people in the corporation, they are called shareholders, and corporation can have no more than 100 shareholders. So these are the different four types of business entities, four forms of business entities. Now, going back to the accounting, there is a private and public accounting. Private accounting is when an accountant is working with one company only. So they prepare their financial statement for one company, or they do their bookkeeping, payroll clerk, uh, cost accountant, general accountant, all of those, they will only work with one company. So those are private accounting. If they happen to work with many companies, so it's then is a public company. So a public company, it can be an individual accountant, like an individual CPA accountant can go and work with few companies at the same time. Also, accounting firms, they can work with few companies also in the same time, and they prepare the financial statements for all the companies they work with. And so, like I said, the CPA is the certified public accountant. There's a 5 different accounting certifications. There are more, but those are the 5 that known more, which is the CPP, certified payroll professional, certified management accountant, CMA, certified internal auditor, CIA, certified information systems auditor, CISA, and certified public accountant, CPA. So a lot of people, when they hear about accounting and accounting degree, they all think about CPA because that's what most of the people do. Because if you want to work, like I say, in by yourself, you need to have a you need to be a certified public accountant in order to do so. So a lot of people, they take the approach to for the CPA, and there's other ones that uh, you can also do and get certified in. There are 5 elements of accounting that we're going to discuss in financial accounting. Officially, there are 10 elements of accounting, but we're only going to speak about 5 in financial accounting. Once you get to intermediate accounting, you will learn more. So the 5 elements of accounting are assets, liabilities, owner's equity, revenues, and expenses. So what is an asset? Assets are future economic benefits. So assets are something you own and it has a future economic benefit. So that's all you need to know for right now. Assets is something you own and it has future economic benefits. For example, cash. Cash is something you own. Does it have future economic benefit? Yes, you can spend the cash in the future. So it does have a future economic benefits. Accounting receivable. Accounting receivable is something you own. You did the work, but you never got paid. Does it have some future economic benefit? Yes, it has future economic benefits because you are getting paid in the future. Prepaid, for example, it can be prepaid rent, prepaid insurance, anything that you pay in advance. So if you paid something in advance, let's say you paid your rent, you paid 12 months of rent, a whole year, and you only used 1 month. So you have 11 months left in your prepaid rent. So those 11 months are the future economic benefits. So you to use those in the future. Equipment that you are is working, you're still using, it has a future economic benefits, so that's an asset. Inventories, you have an inventory that is not sold yet, which if you're going to sell it, it's going to be sold in the future, that's a future economic benefits, that's an asset. Liabilities are future sacrifices. That's all you need to know. Liabilities are something you owe and it has a future sacrifices. For example, account payable, it has a future sacrifice. You're paying something in advance, like in the future you are paying something. Sorry, not in advance. In the future you are going to pay something. Salaries payable, in the future you are going to pay salaries to your employees. Interest payable, in the future you are going to pay interest. And as you can see, not all the liabilities ends with the word payable. So we do have unearned revenue. Unearned revenue is you got paid but you never did the services or to earn that revenue, so it goes unearned revenue. Does it have future sacrifices? Yes, because you will have to sacrifice time in the future to provide that service to earn that revenue. Owner's equity or capital. Equity is how much the company have. That's all. Equity is how much the company have. We're talking about money. So if you add money that the owner contributes, and you take out the drawings, and you add also the net income, and you take out the net loss, that would be what is the value of the entity of the company, sorry, or entity. Revenues are inflows, are cash inflows when you make that are coming from sales. So revenues can be fees earned. You did a service, you got paid for the service, so you earn the fee, so fees earned. Sales, you sold something, no, that's a revenue. Interest revenue, so if you have bonds or you have interest revenue. And also the gains are also go into revenues. Expenses are cash outflows that results from revenues. So for example, cost of goods sold. So cost of goods sold at the beginning, it came from where? You sold an item. Item was in inventory. So cost of goods sold came from inventory. So you sold the inventory and the account is cost of goods sold. Supplies expense also came from supplies. You use the supplies, now you expense it because you use it. Miscellaneous expense, it can be any expense that you use. It can be, let's say you have a prepaid rent, like we said before, and you paid 12 months but you used 1 month, so those 11 months are going to stay in the prepaid rent, but the 1 month that you paid is going to move to rent expense. So anything that you use, you expense. Anything that you use, you expense. And also you expense any losses that you have. Okay, now that we know all the 5 elements of accounting, you need to know the accounting equation. And this accounting equation is going to come back after you in your whole life as an accountant. Assets equals liabilities plus equity. That's you will see it your whole life as an accountant. Now I'll tell you why later. So I will end with the financial statements. There are 4 financial statements. There's an income statement, statement of owner's equity, balance sheet, and statement of cash flow, and they go in this order. So first you prepare an income statement. Once you prepare an income statement, you take your revenues minus your expenses. Your revenues minus your expenses. So for example, you can see here the sales and all of that are the revenues, and then they take out all the expenses, and then you have the net income right here. So it can be net income, net profit, or net loss if the company is losing business. The reason you need to prepare this income statement first, because you will need it to prepare statement of owner's equity. So statement of owner's equity, it reports the changes of owner's equity during that period of time. So first you take the beginning of the period equity, you add contributions and net income. If there is a net income, you add it, or net profit. You add that to it. Then you deduct any draws that you did, and you also deduct, it is not in here, but if it's a net loss, then you deduct net loss also. If it's a net income, you add it, and if it's a net loss, you deduct it from the owner's equity, and then you get your final owner's equity for that period, your ending owner's equity. Balance sheet, and you can see this is the formula that I was talking about. Balance sheets reports assets, liabilities, and equity. There's one thing you need to know. Why it's called a balance sheet? Because assets needs to balance liabilities and equity. They both needs to equal. Assets needs to equal liabilities and owner's equity. If they don't equal, then there's something wrong with your balance sheet. And the final one is the statement of cash flow. Statement of cash flow is just a statement that you see the cash flow, cash coming in and cash going out. So it has 3 sections, which is operating activities, investing activities, and financing activities. And also once you add all the 3 sections together, then you add the beginning of the year, and then you get your cash at the end of the year. So statement of cash flow only deals with one account, and only one account, which is cash. We don't deal with any other account, we only deal with cash. So this was the last section of the PowerPoint. If you want the PowerPoint, you can go to the link in the description and download the PowerPoint. And also there will be more practices there if you want them. And if you like the video, don't forget to subscribe so you can get notification when more videos are posted. Thank you and have a great day.